Let's talk about the iShares Russell 1000 ETF, ticker IWB. Is it a smart way to broaden your portfolio, or is it just more of the same stuff you already own? We're going to dig in and find out. I'm going to start with a pretty bold statement here. If you own a broad U.S. stock market fund, you basically already own this ETF. You just might not realize it. But is it really that simple? Well, that's what we're here to figure out. We're going to dive into the data and see what really makes this ETF different, and more importantly, whether those differences actually matter for your bottom line. All right, before we get into the nitty-gritty, our usual disclaimer. This is all for educational purposes. It is not financial advice. And for context, all the data you'll see is as of March 2026. Okay, let's start at the beginning. The IWB ETF is built to track the Russell 1000 index. The concept is actually really straightforward. It's just the 1,000 biggest publicly traded companies in the US, all weighted by their market size. Simple as that. So what is IWB? Well, it's the ETF from BlackRock's iShares that mechanically follows that Russell 1000 index. It holds about 1,010 companies, and with that, it covers a huge chunk of the American economy. We're talking something like 92% of the entire US stock market's value. And that really brings us to the central question here. A lot of you probably already own an S&P 500 fund, something like SPY or VOO. So if that's you, why on earth would you need to add IWB to your portfolio? Now, on the surface, the argument for IWB seems pretty compelling, right? It holds nearly double the number of companies as an S&P 500 fund. You've got over 1,000 stocks versus about 500. And more companies, that's gotta mean more diversification, doesn't it? Well, here's the catch. That potential for extra diversification, it comes at a cost. IWB charges an expense ratio of 0.15% a year. Now compare that to a super low-cost S&P 500 fund like VOO, which only charges 0.03%. Let's just be crystal clear about what that means. You are paying 5 times more in annual fees for IWB compared to its main S&P 500 competitor. That is a massive difference that really adds up over time. And here's what that looks like in the long run. If you had $1 million portfolio, over 30 years, that tiny-sounding fee difference would cost you an extra $14,500. That's money that could have been compounding for you, but instead it's going straight to the fund manager. And this really gets to the heart of it. You're paying 5 times more for what turns out to be almost identical exposure. But you might be asking, is the exposure really identical? Let's see how they actually perform side by side. When we look at performance, this number here says it all. The correlation between IWB and the S&P 500 is about 0.98. Now, since a perfect 1.0 means two things move in perfect lockstep, a 0.98 tells us their day-to-day movements are pretty much indistinguishable. And that super high correlation, it translates to nearly identical results in the real world. This table shows the 10-year average annual return for both funds. And as you can see, the cheaper S&P 500 fund actually did a little bit better, and that's most likely because of its lower fee. So you're paying more for the same, or maybe even slightly worse, results. So why are they so similar? The answer is all about concentration. Both IWB and the S&P 500 are completely dominated by the same giant tech stocks. The Magnificent Seven alone make up about 30% of IWB's total weight. So even though you own 1,000 stocks, the performance of just 7 of them is driving the bus. So what do you actually get for that higher fee? Well, you get about 500 extra mid-cap stocks. These are the medium-sized companies ranked from 501 to 1,000. But maybe the most interesting difference is the philosophy behind the index itself. IWB is purely based on rules. See, the Russell 1000 is totally objective. If you're one of the 1,000 largest companies, you're in. End of story. The S&P 500, on the other hand, is chosen by a committee. Sure, they have rules, like a company has to be profitable, but they also have some discretion. That means a huge company might get left out of the S&P 500, but it would automatically be included in the Russell 1000. So, when is IWB actually the right choice? There are really just 2 main scenarios. First, for big institutions whose performance is measured specifically against the Russell 1000 index. And second, for investors who want to build a complete U.S. market portfolio using only the Russell indexes, by pairing IWB with its small-cap partner, IWM. For most of us retail investors, though, the risks are really what we need to focus on. First is concentration. With almost a third of your money in just 7 companies, you're not nearly as diversified as you think. And if you already have an S&P 500 fund, you run into overlap risk. You're not diversifying, you're just buying more of the exact same stocks. And that brings us to the final verdict. Look, owning IWB isn't wrong. It's a perfectly solid fund that tracks a major index. But for the vast majority of investors, especially those who already own an S&P 500 fund, it's just unnecessary. You're paying more for the performance and exposure that you've already got. And remember, this was for educational purposes. Always talk to a licensed financial advisor for decisions about your own personal situation. Thanks for joining us.